All right. We got the magic red bar. We are live. We are live. Oh, here she comes. She figured it out. Chris is here. All right. This is a commercial real estate news show, and I am your host, Amy Palvido, coming to you live from Leesburg, Virginia. I am at the DICE National Conference, and I'll be speaking later today. And I've got my friends in the house who are going to, expound on their wisdom of all things kind of commercial real estate. We got a lot to talk about today. There's a lot going on in the world. But I will let them introduce themselves. Go first, Mr. Auerbach.
David Auerbach. I'm a REIT industry veteran that wears a variety of hats. I publish a daily REIT newsletter. I do consulting on behalf of REITs in a variety of capacities. I'm also the chief investment officer of Hoya Capital. We manage 2 REIT and real estate ETFs listed on the New York Stock Exchange with about $130 million under management. And for the next generation of leaders, I have a REIT jobs board, allthereitjobs.com, helping our future generations get their feet into the REIT industry.
That is awesome. And Deanie?
Deanie Taylor, previously in the REIT world for several years. Now CEO and chairman of Landmark Healthcare. We develop outpatient medical buildings all over the U.S.
Very cool. And Chris, are you there, girlfriend? I see her. Maybe she's there. Maybe she's not there. All right. Well, hopefully she'll be able to connect. She's at her house and things are happening. So we'll get her in here soon. All right. Let's get started. All right. Let's talk about my favorite topic, and which is, what the hell? Let's do tariffs first. And it's always a moving target with that one. So we'll do that one first. So I had a show. It was for the members. It was on May 7th. And I had John Jones from NAREIT, and I had Patrick Murphy. And then I had Spencer Levy, who is the chief economist at CBRE. And we were talking, like, how do we navigate this kind of the headwinds of everything that's being thrown at the industry from an economic standpoint. And tariffs is one of those topics we can't avoid. So it'd be really cool to see if y'all can talk through, like, what are you seeing? I mean, from a supply chain standpoint, I guess, or is it affecting anybody, or is it slowing anything down? So I'll throw that one out. Anybody want to jump on that one?
Well, I've spent the last 3 weeks in various meetings with some of the top general contractors that do medical, whether that's hospitals, medical buildings, whatever. Mm-hmm. And the word on the tariffs is, at best, at worst, let's just say at worst, people are putting about a 2 to 3% increase potential, and most are putting that in a contingency where they are making subs or whoever's got product that would be impacted by the tariffs in a bucket that they've got to prove that the increase is tariff related before that contingency will be used. And so it's not, from that standpoint, it is not slowing projects down. I think when it first came out, we were talking about 10, 12% crazy numbers, and that scared people initially. But in the last 3 to 4 weeks, it has really come back down, and most are putting this little contingency in place that if they can substantiate that increase, because you've gotten pricing already up to a point, and then all of a sudden, if it jumps due to tariffs, they need to prove that increase is tariff related, and it can come out of that contingency. But the contingency is not that big, 2 to 3% of total product on total project costs, and it is unit specific by the materials that are impacted. And I've heard from hospitals that even on medical equipment right now, the supply chain's no different than what it was before, where the delay, those things that have taken a long time still take a long time, but it hadn't hit that yet on the supply chain for medical equipment. That's what I know so far.
What are the biggest countries on medical equipment? Who produces? Is it China?
No,
Who
no,
makes
no. It's coming out of Europe. A lot of
it's coming
stuff's
out of
coming
Europe?
out of Europe
Yeah.
on
So,
imaging, things like that, the
oh,
components.
interesting. And so it's kind of funny. They wrapped up a China agreement pretty quickly, but the other countries have been a little slower to
Yeah.
figure out what we're doing, right? So
And I don't know how serious that China agreement really is, and
Yeah.
and exactly which products, you know.
Yeah.
If the tariff's easy on toys, I could really care less.
For sure. I mean, I think for anybody, if steel is what everybody cares about, right? So that's Canada, and lumber is Canada, and we gotta kind of figure that out for sure. And so hopefully we do. I don't know. It's interesting.
So I obviously have some pretty good insights. I've spent, since we haven't connected in a while,
I
and I've been
know.
coast to coast, and I've met with, I can't tell you how many number of REIT management teams over the past couple of months. And for those that follow me on LinkedIn or Twitter, you see how much research I'm publishing about this stuff. You know, the publicly traded REITs just wrapped up earnings season. Every single company was asked this question. I've had one-on-ones with these management teams asking these same questions, you know, and a lot of them kind of are echoing what Deanie has said to this point. You know, the real high level takeaway here is that at the company level, at this point, earnings haven't changed, dividends haven't changed, operations haven't changed, but yet the stock prices are down 30%, or they were down 30% on the news. And to these REITs, these property landlords, owner operators, et cetera, of these properties, you know, you talk to let's say SL Green, which is a New York office landlord, as an example. Their job is to rent out the space. Unless they're developing new properties right now, which would be using, let's say, some form of timber and steel, which might be exposed to some of these tariffs. At the property level, they are not exposed to tariffs. Their tenants might be exposed to what's going on there, but to the actual landlord themselves, there is no exposure. But the stock price is indicating that the sky is falling and it's the end of the world. And looking at what a lot of these REITs have reported, they put up pretty good numbers this quarter. Some slightly cautious language with the word being kicked around. And if I had $1 for every time we've heard the word recently, I'd be retired. Uncertainty. Until we have more certainty of this uncertainty, it's business as usual for a lot of these companies. They're not going to put their head in the sand and go hide and wait for things to smooth over. They're combating this head on and ready to take this head on. I think the only sector that's really seeing meaningful impact right now from this would be the lodging players, but it's for a different reason than because of tariffs. The lodging guys have seen weakness because of, let's say, what's going on with Doge and some of these other impacts that are having on the sector. Group travel businesses declined, et cetera. But from the REIT parent high level situation, the lending window is wide open. The REITs have raised billions of dollars of new capital in the past couple of weeks. M&A deal activity remains robust. We just saw a massive, I think it was an $800 million deal or a $700 million deal of Ryman Hospitalities buying the JW Marriott in Phoenix last night. So it's business as usual for a lot of these companies, regardless of what's going on in the broader economy.
Right.
Yeah. So is it because nobody believes them anymore? Is it because they think that this is all going to work out and this is just a ploy and eventually it's all going to work out and we're going to be able to do it? Or is it they just can't wait around to deal with the noise that's coming? I'm just wondering.
I personally think it's a little bit of both. And, you know, let's unpack it. Until we actually know specific numbers, specific sectors, specific countries, and here's how this is going to play out, and this is the be-all, end-all number, and it's in effect from here until whenever, that's one side of the equation. But as we work out these agreements with these countries, we have these discussions, and then the can keeps getting kicked further and further down the road. That just leads to uncertainty, and companies can't sit around and operate in an uncertain environment. You have to focus on business as usual. Deanie can tell you from working in the world of publicly traded REITs that you got two things to focus on: hitting your guidance number this year, or whatever you're guiding for your earnings, and hitting your dividend. You don't want to cut your dividend. You want to grow your dividend, because the safest dividend is the one that just got raised. And we have seen multiple examples of REITs that have both raised guidance, raised their dividends, and it's business as usual for these guys, regardless of what is going on, like I said, in the broader world that's out there.
Yeah. I would agree. And on the development side, where we're watching the construction piece of this, it's impressive how the major general contractors are monitoring what is being said every day and rerunning their numbers to stay on top of this. And that's why that 2 to 3% contingency is a good number. They're not just saying that because they listen to the news and that kind of thing. They are actually watching what's happening at each of the countries and by materials and all. But I will tell you what they're more concerned about, and it has nothing to do with tariffs. It has everything to do with the immigration policy. Staffing of general contractors is likely going to slow things down or cost a whole lot more, and it's going to be a lot worse than tariffs.
Yeah, for sure. Hey, Chris. Talking about staffing of contractors, she can tell you all about it.
Well, our guy, we haven't, as far as I know, we haven't seen any issues to date, but we've got 200 plus guys across the country, but they've all been with us 10 to 15 years. So it hasn't impacted us yet, but I'll keep everyone posted.
Amy, I got one more point to add.
Yeah.
And I don't mean to cut Chris off. Nice to meet you, Chris.
Nice to meet you.
When you look at partners, and people are concerned about foreign investment coming into the U.S., are all these tariffs and stuff going to impact foreign dollars or sovereign wealth funds from coming in and investing with us? I participated in an event in Africa a couple of weeks ago as part of a larger global audience. And, the big takeaway from this event was that the United States represents 70% of the global commercial real estate market. And so, regardless of what's going on here, if you are sovereign wealth funds such as Government of Singapore, Norges Bank, Abu Dhabi Investment Authority, Canadian Pension Plan, the list goes on and on, where else are you going to invest? You're going to start U.S. first, regardless. Number two, remember that a sovereign wealth fund, one of these deep pocket guys, doesn't give two you-know-whats about what's going on in this short blip of time that we're dealing with right now, because those type of investors look at these investments with 25 to 50-year lenses. And so it's not what's happening today. It's what does this investment look like 25 years from now, 50 years from now? And so with all this volatility that we're seeing in the markets, if anything, if I'm a sovereign wealth guy, I'm salivating. I'm getting ready, because now you're able to buy discounted assets at again, great prices, and just friggin' ride the income stream for the next 25 years. This is talking about creating that next level of generational wealth for those investors because of what's happening right now.
Well, as long as we have people to work on those buildings, I don't know if he deports them all, we might not have anybody. Look, I'm gonna be for real. I was a Texas general contractor. Half of my 2/3 of my staff were immigrants. Like let's be real. Most of the construction is that. And if he's gonna deport them, I have to do this, and I hate to do this. But did you hear about the Hunger Games to get a visa? Did y'all hear about that? I'm like, really? Come on, y'all. Do we have to do that? Like, I don't know. But it's a big topic. But I mean, I guess if you're going to disrupt things, you're going to disrupt things. I don't know. I think it's crazy town. So, okay. So, one other thing we want to talk about. Is the credit rating. So what about the whole thing around the credit rating? What happened there? I'm at a conference, y'all, so you're going to get background noise. But what is that? How is that going to impact us, you think? We downgraded our credit rating. If y'all don't know, basically our dollar is not, or we don't think is it the same as the tariffs?
No,
Deanie can probably share, but sorry, Chris, go ahead.
No, I was just going to say it's that the United States debt is no longer a AAA investment. So you're going to, it's generally considered to be like the safest, if one of the safest, if not the safest investment is U.S. debt. And now it's not.
What does that do for the real estate industry, though? Does it do anything? Does it not? Or what is it, Deanie? Does it impact us in any sort of way?
Unless it impacts rates, it won't impact me. And so that's what I'm going to watch.
I mean, it is, and Deanie's right. It's all about rates right now because it is impacting rates. You know, the 10-year at this moment's at 450, basically 449,
Right.
450. You know, it just kind of pushes us towards 5, which kind of puts REITs out of favor and all that other stuff. But,
Right.
you know, on the surface, it's not a good look. Let's be honest. It's not a good look at all.
Yeah, I think it's definitely an interesting thing. Maybe it's temporary. Who knows? Does it affect foreign investment in the U.S. real estate though, or does it not?
I don't think so.
Yeah, goes back to where else are they going to go?
Sure. Very cool.
And by the way, it's not like we have a ton of office buildings that are under development right now, or a ton of malls that are being developed coast to coast. We might be seeing some shopping centers because, you know, Amy, we talk about this in far north Texas and how that population shift keeps going north. But again, it's not like we're seeing a massive wave of some of these underloved property sectors being developed right now. When you talk about development, the one sector that gets all the attention is resi, multifamily. So that's the sector that's talking about, let's say, tariffs and rising construction costs the most. But at the end of the day, going back to what Deanie said, and I think we lost Amy, she's gone for the day. You know, I think, again, if it's a de minimis raise, I think they're going to be able to push that off to the end owner and tenant at the end of the day. You know, if it's a 5, 10%, 20% tariff, obviously a lot of those projects are going to be put on pause. But I think a lot of that's still TBD.
Yeah.
There she is.
You didn't lose me. I just had to plug in my laptop before it died. So, you know, at a conference, it's what happens. Nothing works. Everything dies. No, it's okay. So if we're going to talk through, so the same thing on the retail side, anything like that. So if we look at foreign investors and what they're looking at, though, and what they're trying to, yes, they're not going to go anywhere else. We have a big, huge market. Does the ability of our dollar, does it affect in anything on the lending side? Does it, or does it not? It doesn't matter. It's just all interest rates. The dollar doesn't, I just think it would have a bigger impact if our credit rating sucked. I don't know. It doesn't really suck. It just downgraded a little.
I don't know how to answer that. Again, I think it depends. You know, again, publicly traded REITs are not having an issue raising capital. So they can go out and raise a ton of money right now and be self-funded. Again, Deanie sat in that chair. He can talk to that extent more than I can from where I sit. And again, for some of these sovereign wealth funds, you know, there might be exposure on the dollar when it comes to FX, foreign exchange, and all that fun stuff. But I don't think it's going to necessarily impact their decision of, do we partner on this deal or not? Because again, they're looking at it with a long-term investment horizon. What do you think, Deanie?
No, I would agree. And I first of all, you are right about the capital that's available. There's plenty without worrying about foreign investors. And as it relates to how we're looking at sourcing capital, the ability to get foreign capital really surprises me. I mean, they really are interested in development. And but you're right, it's long-term type stuff. It's the medical buildings that last for a long time that foreign capital is looking at. And Amy is gone.
I mean, I've got to think if I'm a foreign, again, this is just my speaking off the cuff. If Empire State Realty Trust was shopping the Empire State Building for sale, you can imagine the number of sovereign wealth funds and investors that would be backing up the Brinks truck to get a piece of that action.
Sure.
Because that building is not going away anytime soon, regardless of, oh, the office is dead. Oh, New York is dead, whatever it is. Like some of these trophy assets that we have coast to coast are going to be around for the next 50, 100 years.
Yep. Nope, you're right.
And we're going on
Amy?
a walk right now. Where are we
Yeah.
walking to, Amy? Give us a play-by-play.
We're walking at the conference, and I'm trying to find a place that kicked me out of the room I was in, but that's okay. I'm trying to find a place with a plug. So let's talk about, so you're going to walk with me. It's all right. Welcome to Amy's world of being at a conference. Okay, let's talk about how real estate companies get AI ready. That was one of the other topics I wanted to talk about, and I don't think they are. And what is that going to do for like investment in the kind of in the future? I want to talk through that topic.
I mean, if you're not investing dollars today into it and talking to a lot of these REITs, they are deploying a lot of capital to it. You know, you better get on board now and get behind it. That's just my opinion.
Interesting.
Yeah. No, and the early adoptions was related to how AI helped with leases and asset management, all the things to be more efficient. But it's clearly being incorporated into the day-to-day.
So is it, but are they, so this topic around being ready, do you think that the real estate companies, that their data sets, that they have the ability to really take advantage of any sort of inferencing at the moment? I mean, I would just think that the ones that I've talked to, that the data is pretty disjointed and they have to do a lot of work to even get ready to even sort of deploy a true AI application inside where it's doing autonomous kinds of things. Or is that not true?
I can tackle this one.
Yeah.
It's a numbers game. It's a money game. Okay. For, again, a large cap REIT, the guy that's in the S&P 500, you know, that's got multiple billions and billions of dollars of market cap, just to throw names out there like a Prologis or a Simon Property Group. Again, we know who the REITs are in the S&P 500. They've got a lot more dollars to deploy and do that versus a small cap REIT that is cap constrained to try to allocate resources to that. So I think it's a game of have versus have nots. Those REITs that have the large market cap can deploy a lot of money to that versus a smaller company that has to rely on others to implement that strategy, if that makes sense.
Yeah, for sure. And so what about in like on the medical side, Deanie, where do you think they're at?
Well, for the last 5 years, the two REITs I'm familiar with have been investing in organizations that were looking at all the innovative types of AI tools that were going to come. So they've been watching what's out there and playing with it, testing it, things for the last 5 years. And now I think some of that is being adopted. It's not and it's really not I've not, up until last year when I was in the REITs, it was not talked about as too much capital to incorporate some of that. But again, they were starting with some of the basics, managing leases, which is a problem for the landlords that have thousands of leases. You'd be surprised how archaic it was up until these last few years to manage just knowing when renewals were.
Yeah, or what
And-
the restrictions were inside the leases. And who you
Exactly.
could not lease
And then you add to it, it's very common for all the medical to have ground leases, which really has to be monitored when you go looking for tenants that might violate a ground lease. And so all of those things now are being managed by AI.
Yeah,
You've got tools that will warn you of problems.
yeah.
So all of that now, that's where it's mostly been used at this point.
So, Chris, since you're our building systems IoT connectivity person on the call, this is really, really for you. So, are the real estate buildings connected enough to really take advantage on a building performance side to use AI tools yet, or are they getting there?
Well, I think the thing is that, and I just got up and got my notes on this. I was at the fire summit a couple of weeks ago, which was phenomenal. Big shout out to Matt Knight for like making magic happen. But one of the sessions was on AI, and I think that the thing is, like, what we've got right now isn't even really AI, right? It's a bunch of algorithms. So I think we're collecting a lot of data. So we do on, it depends on the property, it depends on the asset class. I think we are collecting a lot of data. And but the problem is it is all disjointed, Amy. And so like I think we've got the connectivity in a lot of places to have the data. It's just that it is all disjointed, and you've got to have some way to make it sane even before you start, using AI to interpret it.
Interesting. So, have you seen any sort of applications around AI used around data cleanliness? I mean, like using AI to clean data or maintain data. Have you seen anything like that? Because I think that's crucial to the industry as well, right? Because we got a bunch of data in all disjointed places, but we need to integrate it and then we need to clean it, maintain it. Have you seen anything there?
I haven't personally, but I think it's, I think there are people working on it, but I haven't personally seen that happen yet.
Yeah, I did talk with one new startup. They're actually out of Ireland, and they just came over to the U.S. And he's sort of doing that, mostly on the integration side, about where you're taking data and you can kind of. It doesn't matter where it is. They do like using AI, and they've changed the game on. You don't have to do APIs anymore. You don't have to do that. It's really cool tech, and I don't know. I can talk to it a little bit, but it's pretty cool tech on what. And I think that's where AI's ability to help us be more productive is now. Data isn't necessarily where you have to have it. It's got to reside in one location. It's part of one software. The data can be separate from the compute, and then you can have like or Databricks or your data lakes or whatever. And that changes the game, I think, in a lot, especially in the real estate side, where we have all these point solutions that all have their own data. If we can actually pull the data apart and use AI to do that in some faster way, then the integration thing becomes an easier solution, I think. But we'll see. We'll see where
Let's
that
put
goes.
it this way. I bet if we're doing this conversation a year from today, it would be a whole different answer and story than what we're talking about right now. Because this is something that is literally evolving by the hour, it seems, at this point.
I know. Yeah, for sure. I know. It's sometimes when you talk about AI, like, oh yeah, that's just like so 6 months ago. so 3 months ago, because it's going so fast. All right. Well, I'm going to cut this one off short because I'm at a conference. So everybody give me your predictions for this next quarter. I don't know. Like, do your predictions for the rest of the year. What do you think? And we're in May. So we got 6 more months for this year. Crystal ball it for me. What do y'all think is going to happen? You go first, Chris.
No, I don't know. I mean, to David's point, everything is changing by the hour. It's like I can't even keep up with the news. I feel like if I don't have the New York Times app constantly open on my phone, that I'm missing something. And actually, the BBC and the Guardian send me push notifications before any of the American news outlets. But I mean, I can tell you what I'm hoping for. I'm hoping that, as things start to, as we get past some of this tariff issue, or as these negotiations are proceeding, and people do have to still continue to do business, that as we get into the second half of the year here, that we're going to see an increase in the adoption of the technologies that are going to allow us to collect all that data and apply AI, and start making use of all the, of all this, start making everybody's life easier and making things more efficient. But there, that hardware, that tech still, and that connectivity piece is still, we're behind the eight ball. So hopefully, second half of the year, I'm hoping that we see some kind of shift. And fingers crossed, we are seeing an uptick in deals now on the prop tech side.
So the FTC did that whole thing with managed Wi-Fi. Did that just die? It died, right? Like
It died. Yeah, no,
yeah.
it's gone. It's FCC.
Right.
Yeah, no, it's gone.
Good.
Yeah, no, it's yeah. So, but I
Right.
mean, and there are some new solutions coming into play in the managed Wi-Fi space. We've got CBRS out there, and using that as backhaul. Like, there are some developments there. So hopefully we can get the cost down somewhat.
That's good. All right, David, your turn.
I mean, when you think about the world of commercial real estate, it's always about cycles. We always see cycles, highs and lows, opportunities, distractions, whatever you want to call it. In my career, 9/11, crash of 2000, 08, 09 housing crisis, 13, 14, COVID, the list goes on and on. And again, for a lot of these companies that are out there, they have no control over the external noise and all the stuff that's going on. All they can do is look inside the company, focus on within, focus on the fundamentals, and operating the company. How do we grow our revenues, cut our expenses, maximize our net income, and pay the most out to our shareholders that we possibly can? What have companies learned over time? Delever, cut the balance sheet. Let's have less debt. Less debt equals less volatility in volatile markets, like what we've been seeing. Let's have I don't want to say minimum, but let's be less aggressive on our dividend payout structure. Let's maybe keep some money in the bank for a rainy day and deploy when opportunities present themselves. As I've said before in many of these conversations, these REIT management teams, and we got a former very senior REIT executive right here in our chat that can echo this. These REIT management teams have been through a lot of cycles. They know when to go on offense. They know when to go on defense. They know what they learned from the last cycle, the last problem, whatever you want to call it, and how to respond to the next time the next event happens. So because these guys operate in long-term vision, long-term glasses, 25, 50-year type horizon in some of these investment properties, I think, again, it's just business as usual. They're focusing on opportunities, but more importantly, they're being more nimble. As we talked about, cap rates are all over the board for transactions right now. Public versus private cap rates are at a wide difference. And so for a lot of these guys that are trying to transact, they're digging in their heels. This is a 6 cap property. I'll give you, I'll pay for a 5 cap or, so a 7 cap. Nope. We're at 6. Neither side is budging. And again, it's because where is this going to be next week, next month, next year? With all this volatility, the markets are kind of moving in lockstep. And so as a result, you sharpen your pencils, get the money in the bank, be ready to act when the opportunity presents itself. So honestly, my take on this, we're operating in this band for the rest of this year until we have some kind of more certainty of the uncertainty. We're going to see deals. We're going to see a boatload of debt being raised. It's business as usual for a lot of these companies.
Ah, very cool.
And by REITs.
And by REITs. Exactly. Deanie.
On the medical front, it's been a while, but we're going to see some large portfolio transactions of hospitals monetizing. There's one that'll close here in the next probably 3-4 months, and there's a couple more right behind it. and that is hospitals realigning and getting more comfortable with REITs or third-party ownership of their medical buildings. Those are going to sell. The second thing is large health systems are looking to third-party capital to develop new buildings. They've waited so long for new buildings in new markets. Either they're protecting or they want to grow market share, and they're having to go. The problem is rents, because of cost of construction and all,
Yeah.
are unbelievably high for new buildings, and they're having to make tough choices about that. But it's development is back. It's really unbelievable. Development is back on the medical front.
Interesting. And so the privatization, like, remember all those heartache questions, back when somebody was going under and they forgot about that. It's like, ancient history, even though it was like 6 months ago or whatever it was. They don't care. Is that
You're talking about providers going under, hospitals?
the hospitals that were private? Remember when we were having that?
Well, that's always going to be the case. These aren't. I'm not talking about private. I'm talking about well-funded, well-capitalized, not-for-profit hospitals and health systems.
Yeah.
That's who we all want to work with. Nobody
Ah.
wants to chase the private stuff.
Okay. All right. Well, very cool. All right. Well, this has been fun. Thanks for being on the adventure and this show. I love this show. We're back together. We're back on Tuesday mornings. We're back. We're going to do it like from now on. So thanks everybody who watched, and we will see you next Tuesday. So, and thanks for putting up with me at my conference.
Bye.
Guys.
Bye, everybody.
Bye.